Good morning and welcome to today's webcast, Compare and Contrast Supporting Organizations, Private Foundations, and Donor-Advised Funds. Before we begin, we are going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I am happy to introduce today's presenters, Pam Alexanderson, Tax Director, and Mike Lumsden, Manager, both members of our not-for-profit practice. Mike, I will now turn the line over to you to begin today's presentation.
Thank you, Pam. Welcome to our webinar, ladies and gentlemen. This webinar will explore the various types of vehicles charitable organizations can utilize to maximize its charitable impact. Specifically, we'll be analyzing, comparing, and contrasting the differing types of supporting organizations, as well as discussing compliance issues for each type of supporting organization. Now, supporting organizations in recent years have been a bit of a hot topic with the Internal Revenue Service, as there's been a lot of activity regulating these entities to curtail perceived abuses by donors. In essence, the IRS believes many of them to be operating as private foundations rather than public charities. This is easily evidenced by the supporting organization sections of Section A on the Form 990, which was drastically revised and bulked up in 2014 to ensure compliance with the Internal Revenue Code. As such, given their popularity and the complex tax issues which arise, we felt this course would be a good refresher for many of you operating supporting organizations. Thereafter, we'll be changing gears just slightly to discuss the differences between donor-advised funds, which I know are a popular vehicle to attract philanthropy, and private foundations. We'll touch on the pros and cons of both, as well as highlight the charitable deduction rules for donors for each. And without further ado, we'll begin the webinar and get into the meat and potatoes of the presentation. All right, starting out with the very basics here. Who or what are supporting organizations? Well, a supporting organization is a tax-exempt organization qualified under IRC Section 509A3. Now, to provide some additional background here, all tax-exempt organizations described in Section 501c3 are subdivided between public charities, which receive a broad public support from gifts or fees, and private foundations, which received almost all of their income, other than investment income, from a very narrow group of persons. These individuals, it can be a single individual, it can be a family, or it can be a corporation. By default, these organizations are private foundations unless they qualify as public charities described in Section 509A1, 2, 3, or 4. Now, in general, 509A1 organizations include churches, schools, hospitals, and other organizations that receive their public support primarily from gifts, grants, and contributions from a broad group of people. Section 509A2 covers organizations that receive their support from a combination of gifts, grants, and contributions, and as well as fees from their exempt services. And Section 509A3 covers supporting organizations, which is the subdivision under the public charity branch we'll be discussing today. The last section, 509A4 organizations, aren't really seen too frequently, but they are organizations which test for public safety. But as I mentioned, these really aren't too common out there. Now, what's great about supporting organizations is that it is a charity that carries out its exempt purposes by supporting other 509A1 or 509A2 organizations. And on occasion, organizations organized under 501c4, 5, and 6 of the Internal Revenue Code. Thus, these organizations do not have to be formed for a particular charitable purpose or to raise a certain amount of public support. Instead, these organizations qualify as public charities because they support the exempt activities of other public charities and maintain a close relationship with these public charities. Now, this is important because it is one means by which a charity can avoid classification as a private foundation, a status that is subject to a more restrictive regulatory regime, and Pam will touch on later in this course. Now, I did mention that supporting organizations can support other types of organizations not qualified under Section 501c3. This includes organizations qualified under 501c4, C5, and C6. It's important to note that this would only be valid if these 501c4, 5, and 6 organizations satisfied the public support tests applicable to a 509A2 organization. Thus, a calculation really should be performed for the supported organization in accordance with Section A or Schedule A, Part 3 of the Form 990 to ensure that this is indeed facts. Now, setting up a supporting organization isn't too difficult, but it does involve a bit of red tape. To set up a supporting organization, an organization can request supporting organization status when it files its Form 1023, its application for exemption, or it can subsequently request it through a determination letter by submitting Form 8940 to the Internal Revenue Service. All right, moving on to the different types of supporting organizations. Section 509A3 contemplates 3 types of relationships between the charities and their supporting organizations. The relationships are categorized as Type 1, Type 2, and Type 3, and each type bases its justification for exemption on slightly different language in the code section. Type 1 organizations must be operated, supervised, or controlled by its supported organization, and thus can often be viewed as parent-subsidiary relationships. Type 2 organizations must be supervised or controlled in connection with its supported organization, and thus can often be viewed as brother-sister relationships. And Type 3 organizations must be operated in connection with its supported organizations. Type 3 organizations are further subdivided into 2 types: functionally integrated and non-functionally integrated organizations. Type 3 organizations, as we'll see, really were the focal point of the more stringent regulations the IRS has placed on supporting organizations, as there was a lot of concern that these organizations really were operating more akin to private foundations, but were shielded with public charity status based on the fact that it was a supporting organization. So yeah, we'll really go into the requirements for Type 3 organizations later in the course, just to make sure that these organizations are in compliance with those laws and regulations. Moving on to discuss the various requirements of supporting organizations. Now, to qualify as a supporting organization described in 509A3, an entity must meet 4 tests. 1, the organizational test, 2, the operational test, 3, the control test, and 4, the relationship test. We'll go into each of these tests more in detail one by one, but in general, the organizational and operational tests generally require that the supporting organization to be organized and at all times operated for the benefit of, to perform the functions of, or to carry out the purposes of one or more specified supported organizations. The control test generally requires that the supporting organization not be controlled directly or indirectly by one or more disqualified persons other than foundation managers or one or more specified supported organizations. And lastly, the relationship test generally requires that the supporting organization be operated, supervised, or controlled by, or controlled in connection with one or more specified supported organizations. And really, without this relationship, without some type of connection to a public charity, the organization would be classified as a private foundation. Ultimately, supporting organizations are classified as Type 1, Type 2, and Type 3, both functionally integrated and non-functionally integrated, based off how they satisfy this last test, the relationship test. And with that, that brings us to our first poll question. And again, make sure you respond to these poll questions just to ensure you get credit for CPE. But the poll question says, supporting organizations are classified as Type 1, Type 2, Type 3, functionally integrated and non-functionally integrated, based off how they passed what test? The organizational test, the operational test, the control test, or the relationship test. We'll give everyone maybe 30 seconds to answer. About 15 more seconds. All right, I'm about to close the poll. Let's see what the results are. All right, looks like the majority of you got it right. Correct, it is the relationship test. These are the 4 tests for supporting organizations, but they're classified as Type 1, Type 2, or Type 3 based off the relationship they would have with their supported organization. All right, now going a bit deeper into each of the 4 tests required of supporting organizations we outlined. The first one we're going to take a deeper look into is the organizational test. All types of supporting organizations must satisfy the organizational test. The regulations explain that the supporting organization will only meet the organizational test, which is the requirement that it be organized exclusively for the benefit of, or to perform the functions of, or to carry out the purposes of one or more specified public charities, if its governing documents meet certain requirements. Thus, for those of you who utilize supporting organizations within your structure, the compliance check here is to analyze the organization's articles of incorporation. The first item you want to look for to ensure compliance is to ensure that the supporting organization specifies which charities it will support. Additionally, the documents cannot explicitly allow it to operate to support other entities. Now, the method of specifying a supported charity in the organization's governing documents varies based on whether the supporting organization is a Type 1, a Type 2, or a Type 3 organization. Type 3 organizations have a stringent standard, which again is a theme we'll see throughout this presentation, for specifying their supported charity. The governing documents of Type 3 organizations must specify their supported organization by name. Now, on the other hand, Type 1 and Type 2 organizations have a more generous standard than Type 3 organizations for specifying their supported charity. In addition to specifying the supported organization by name in the governing documents, Type 1 and Type 2 organizations may also designate their supported charities by class or purpose. Now, what is meant when we say class or purpose? A good example would be a supporting organization of a hospital system. Now, the creation or acquisition of a new hospital within the system would not warrant the amending of the Articles of Incorporation of the supporting organization to include the new hospital's name. Rather, if there was blanket language which indicated the supporting organization would support all hospital entities of the designated health system or entities providing healthcare services within the health system would suffice. Now, again, this last bit, the class or purpose, is not available to Type 3 supporting organizations, only Type 1 or Type 2 supporting organizations. Now, we should also highlight that there is a rare exception to the requirement that the supported organization be named in the Articles of Incorporation, and that is if the supporting organization can demonstrate a historic and continuing relationship resulting in a substantial identity of interest between the supporting organization and the supported organization. This burden, however, would be on the organization to prove, but there is this safety net available. Typically, we don't see that too often, however. Now, in addition to the requirement that the governing documents specify the supported organization, there is also what's called a purpose limitations test. It must not empower the supporting organization to perform other activities. Thus, what you don't want to see in the articles is any blanket 501c3 language, which states that it is formed for any other purpose other than to benefit its supported charity. Moving on to the second of the four tests for supporting organizations, in addition to meeting the various aspects of the organizational tests, all supporting organizations must also meet the operational tests. The operational test requires that a supporting organization be engaged in solely activities that support or benefit its supported organization. Examples of these activities include the provision of necessary services to the supported organization, or in the case of a supporting organization which raises funds, grants to the supported organization. In addition to making grants or providing services, a supporting organization can also generally make grants or provide services to the following. 1, individual members of the charitable class benefited by its supported organization. 2, another supporting organization that supports the same supported organization. And 3, a state college or university described in IRC Section 511. Evidently, the IRS wants to encourage giving to these organizations. Now, the last two here, I think, are pretty self-explanatory. However, I wanted to touch further upon what is meant by individual members of the charitable class benefited by its supporting organization in bullet point 1. A good example which would highlight what is meant by this is allowing a supporting organization of a university to make grants either directly to the university or distribute scholarships to students at the university. Now, the students at the university would be an example of the individual members of the charitable class benefited by its supported organization, the university. Now, in looking at the registration list for the webinar, I noted that there are many representatives from community foundations, and commonplace among community foundations is a structure involving many supporting organizations, many of whom provide grants to organizations which aren't its supported organization. Now, some might wonder if these organizations run afoul of the operational tests since they provide support to outside organizations. And the answer is no. Because community foundations support a wide variety of causes, a supporting organization of a community foundation really has tremendous grant-making flexibility. Another similar example would be Jewish community federations, which are set up throughout the United States. These federations have many supporting organizations which provide grants to other organizations, but these grants from the supporting organizations support Jewish causes, which aligns with the purpose of its supported organization. All right, once a supporting organization has passed the organizational and operational tests, it must pass the control test, which is the third of the four tests. Now, the control test simply states that the supporting organization may not be controlled directly or indirectly by one or more disqualified persons. Now, what is the definition of control, you might ask? Well, control would be defined as the practical ability to require the organization to perform any act that significantly affects its operations or to prevent any such act. In plainer terms, however, a supporting organization really is considered control by disqualified persons if the disqualified person's voting power is half or more of the total voting power of the governing body of the supporting organization, or a disqualified person can veto the supporting organization's actions. So you want to see majority control there. Now, having defined what control is, the question then shifts as to who would constitute a disqualified person. It's important to know that when we're dealing with tax-exempt entities, there isn't really a single definition of disqualified person. Rather, it varies depending on what area or topic you are dealing with. And ultimately, it's important really to reference the regulations to define a disqualified person. However, for purposes of dealing with disqualified persons in relation to the control test, disqualified persons include substantial contributors, and these are any individuals or entity who give the greater of $5,000 or 2% of the gifts received by the organization from inception, including gifts by a spouse. So you can see that that gets triggered pretty easily, actually. An owner of 20% or more of the voting power of the organization, a family member of any individual in the categories above, and a corporation, partnership, trust, or estate in which the persons described above own greater than 35%. It should be noted, however, that 509A1 and 509A2 organizations are generally not treated as disqualified persons. Thus, they can control supporting organizations, which we'll see they do with like Type 1 organizations. Additionally, this typically also excludes foundation managers. So the definition of disqualified persons excludes foundation managers. Now, the purpose of this control provision is really to curtail donors from establishing supporting organizations, retain control over the assets they contribute, hoard funds within the organization rather than actually using them to accomplish a charitable benefit, or engage in an abusive financial transaction with their supporting organization. There's kind of a somewhat famous Wall Street Journal article published in 1998 titled "How to Succeed in Philanthropy Without Really Giving Anything." It's really an interesting article if you want to look it up. And this article really tried to blow the lid on individuals who utilize supporting organizations as a means to donate assets to a charity and receive an immediate income tax deduction, but really hold the assets in that supporting organization rather than distribute them to the operating charity. Thus, they were ultimately receiving an individual benefit, but on the flip side, there was no real charitable benefit. One of the real-life fact patterns the article cited was a specific donor who set up a supporting organization for an automobile museum. Ultimately, the donor donated the automobile to the supporting organization, which were to hold the assets until it was distributed to the museum upon completion of a wing to hold these assets. Ultimately, the donor who controlled the supporting organization put a lot of stringent terms on the specifications for the new wing, and ultimately the assets were really just held in the supporting organization. Thus, the individual donor really received the benefit of a tax deduction representing the donation to the supporting organization, retained control of his assets, but ultimately there were no charitable use assets to show for it. Ensuring disqualified persons don't control supporting organizations really is kind of a self-policing of sorts amongst the for supporting organizations. All right, moving on to the last of the 4 tests for supporting organizations, the relationship test. Now, as we mentioned earlier in the course, supporting organizations are classified as Type 1, Type 2, or Type 3 supporting organizations based off how they satisfy the relationship test. However, overall, a supporting organization must have a relationship with a specified supporting organization that demonstrates the supporting organization will be 1, responsive to the needs or demands of the supported organization, and 2, an integral part or maintain significant involvement in the operations of the supported organization. The first one is often referred to as the Responsiveness Test, and the second one is the Integral Part Test. It should be noted that Type 3 organizations, which remember we highlighted have been really heavily regulated by the IRS, must take additional steps, though, to prove that they have a close relationship with a public charity. And we'll go into this a little bit later. However, what I'd like to do now is highlight how Type 1, Type 2, and Type 3 organizations establish those close relationships. All right, Type 1 relationships are really perhaps the simplest relationships to define, and I think they're the most common out there in the realm of supporting organizations. Now, Type 1 organizations must be operated, supervised, or controlled by its supported charity. As we mentioned previously, Type 1 relationships are comparable to that of a parent and a subsidiary, where the subsidiary, which would be the supporting organization, is under the direction of and accountable or responsible to the parent, which would be the supported organization. These types of relationships are established when the supported organization appoints or elects a majority of the officers, directors, or trustees of the supporting organization. Now, as a compliance check, a way to verify this is to examine the bylaws of the organization. And this really does presume that the organization is indeed operating in accordance with those bylaws. Now, all bylaws of an article, all bylaws have an article which define who the board of directors is and how that board may be elected or appointed. If you're a Type 1 supporting organization, you would want to ensure that those bylaws indicate that the supported organization can appoint or elect greater than 50% of the organization's governing body. It should also be noted that the relationship for Type 1 organizations can also be demonstrated in other ways, as long as these show that the supported organization has a substantial degree of direction over the policies, programs, and activities of the supporting organization, and also that the supporting organization is responsive and has significant involvement with the controlling supported organization. Now, this really isn't that common, but it is still prudent to highlight that there is this alternative relationship structure for Type 1 organizations available. But typically, we don't see that too often. Moving on to Type 2 relationships. Type 2 relationships can be more complex than the parent-subsidiary style in Type 1, but they are still pretty easily categorized and defined. Type 2 relationships aren't as prevalent as Type 1 relationships, and I believe are the least common of the three types of supporting organizations. We most commonly see these relationships in a hospital or health system structure. But in general, a Type 2 relationship is one in which the supporting organization is supervised or controlled in connection with a specified supported organization. Now, as we mentioned before, these organizations are more akin to brother-sister entities with a common parent, as opposed to the parent-subsidiary relationship characterizing Type 1 relationships. This relationship can be demonstrated in many ways. However, it is most clearly demonstrated when a majority of the directors or trustees of the supported organization also serve as a majority of the directors or trustees of the supporting organization. Thus, unlike the Type 1 organizations, there is not necessarily the power to appoint or elect a majority of the board by a supported organization. Rather, there's really just this majority overlap amongst the boards. Another example we commonly see, and this harks back to really how common these are in the health systems, is a supporting organization might function as a subsidiary fundraising entity for a hospital, and both the hospital and the supporting organization are both overseen by a parent management company. Thus, the parent management company ultimately elects a majority of the board for both the hospital and the supporting organization. And really, the distinguishing factor here is that there must be common supervision or control. Also, what's important is you would also want to look at the bylaws for all of the entities here, just to ensure that there is that common control. All right, moving on to the last type of relationship, Type 3 organizations. Now, Type 3 organizations are complex. These organizations need only be operated in connection with their supported charity. Given this, the Type 3 structure provides really the loosest connection between the supporting organization and its supported public charity. And as such, these Type 3 organizations have really been the focal point of recent laws and regulations, as the IRS believes many of these organizations are probably operating close to private foundations. As such, the IRS requires Type 3 organizations satisfy two tests within the relationship tests. One is the Responsiveness Test, and 2 is the integral part test. Now, before I get into the specifics of those 2 tests, there are some additional requirements of type 3 organizations which I'd like to go into. First and foremost, and again, this is really unique to type 3 organizations, a type 3 supporting organization must provide annual notice to its specified supported organization. Now, the regulations are pretty specific as to how this notice must be completed, but in essence, it must be a written notice and it must be sent by the end of the 5th month after the close of every tax year. The notice actually must be addressed to the principal officer of each supported organization and must contain, first, a description of the type of support and the amount of support provided by the organization during the preceding tax year. 2, a copy of the supporting organization's most recently filed Form 990. And 3, a current copy of the supporting organization's governing documents, unless those documents were previously provided and there really have been no changes. This is, of course, probably the easiest step, I think, for type 3 or supporting organizations to complete, but I've seen this slip through the cracks on occasion, which really isn't a good answer for anyone involved. Failure to complete this step can result in the organization automatically defaulting to a private foundation, which, as we'll see, isn't advantageous to the organization whatsoever. Now, moving along and discussing the first prong of the relationship test for type 3 supporting organizations, the responsiveness test. All type 3 organizations must meet the responsiveness test, and this is to ensure that the supporting organization will be responsive to the needs or demands of the charity it supports. Now, to satisfy the responsiveness test, there are 2 steps. First and foremost, the supported organization must be adequately represented on the governing body of the supporting organization. Now, what might you ask does adequately represented entail? Well, the regulations and further tax court rulings, and those have actually disagreed previously, they've kind of been in contradiction to each other, but ultimately we're going to go with what the tax court rulings have established. And they've established that adequately represented would be satisfied if the supported organization can appoint at least one officer, director, or trustee of the supporting organization, or if at least one member of the governing body of the supported organization also serves as an officer, director, or trustee of the supporting organization, so there's just that overlap of one individual, or the officers, directors, or trustees of the supporting organization and of the supported organization maintain a close and continuous working relationship. Now, additionally, as a result of this adequately represented relationship, the supported organization must also have a significant voice in directing the use of the supporting organization's income and assets, including investment policies, the manner and timing of grants, as well as also the selection of grant recipients. Now, taking a step back, this significant voice test really isn't defined well in the regulations, and they don't really give a lot of examples as to how one might establish this. But the one example they do give is quarterly face-to-face or telephonic meetings amongst the officers or directors of both the supporting and supported organization. Additionally, it should also be highlighted that the significant voice test does not necessarily mandate that the supported organization dictate how a supporting organization can use its income and assets, but it merely states that it should have some type of say in that. Now, as you can see right away, type 3 relationships are certainly the weakest of those which we have discussed so far, as there is really only a requirement for a supported organization to appoint only one officer, director, or trustee, or there just needs to be overlap of one of those aforementioned individuals. This is really in stark contrast to type 1 organizations, which, remember, the supported organization can appoint a majority of the board, and type 2 organizations, which, remember, where the supported and the supporting organizations are controlled by the same individuals. All right. Now, in addition to meeting the responsiveness prong of the relationship test, type 3 organizations must also meet the integral part test. Now, the integral part test is used to determine whether the supporting organization maintains a significant involvement in the operations of the supported charity, and that the supported charity is in turn dependent on the supporting charity for the type of support which it provides. Now, as we've highlighted previously in this course, there are two distinct types of Type 3 supporting organizations. First is the functionally integrated supporting organizations, and two is the non-functionally integrated supporting organizations. Now, functionally integrated supported organizations meet the integral part test most commonly with what we refer to as the but-for test. In essence, these organizations engage in activities for or on behalf of the supported charity. The crux of this test is the requirement that, but for the involvement of the supporting organization, the supported charity would normally engage in the activities itself. Thus, the example I use pretty commonly for Type 3 functionally integrated organizations is a research auxiliary organization of a university. Sometimes these organizations kind of have a loose connection with the university. Maybe the president of the university sits on the board of the research foundation, but they also undertake activities which would be undertaken by the university if it weren't for the research foundation. It should also be noted that non-functionally integrated supporting organizations satisfy the integral part test by meeting a distribution requirement similar to those of private foundations. This is a bit beyond the scope of the webinar today. It's really kind of a complicated calculation, very similar to that of the minimum distribution requirement for private foundations. It involves evaluation of the organization's assets and distributing either the greater of 85% of its income or 3.5% of the value of its assets. Within that, there also needs to be distributions to organizations to which it is attentive to, and it needs to be 1/3 of that. I'll just highlight that if you do have a Type 3 non-functionally integrated supporting organization, it'd probably be prudent to have a really strong tax advisor, also probably consulting with legal just to ensure that you aren't tripping up any of the rules and regulations with non-functionally integrated supporting organizations. Probably would be prudent. All right. And with that, we come to our second polling question. It's a true or false this time, and it says Type 2 supporting organizations, and Type 2 here, must provide annual written notice to its specified supported organizations containing a written statement regarding the amount of support provided, a copy of its most recently filed Form 990, and governing documents if revised by the end of the 5th month after the close of the tax year. I'll give everyone maybe 15 seconds to respond. All right, 5 seconds. All right, I am closing the poll. All right, this was a bit of a trick question here. It's actually false because it is actually only Type 3 supporting organizations, not Type 2. So Type 1 and Type 2 supporting organizations do not have to provide that. Granted, it might be good governance to provide that, but Type 3 supporting organizations are the only ones who are required to provide. All right, lastly, I'm just going to touch on some of the benefits of supporting organizations. I think probably the main benefit would be that there really is flexibility on the sources of funding for supporting organizations. Unlike other public charities, there's no real requirement for broad public support. Thus, you don't need to prove on Schedule A, Part 2 or Part 3 that you do meet that 33% support test. Also, there is no limit on investment income for organizations defined in 509A2. There is a limitation on investment income, and that's highlighted in Schedule A, Part 3. So that's very nice. Also, it avoids the stringent rules and regulations applicable to private foundations, which Pam will touch on a little bit more later in this course. In addition, there is limited liability by placing certain assets or activities in a separate legal entity. Some disadvantages of supporting organizations. Well, I think as we've highlighted, there's detailed restrictions on activities and grantees. You can't just provide funds to anyone that you wish. It really just needs to be operated for the benefit of your supported organization. Also, Form 990 Schedule A has really been significantly revamped. And for supporting organizations, there's a lot of more detailed reporting, which those supporting organizations have to undertake. And failure to meet the requirement of the regulations results in the reclassification to private foundation. Lastly, the regulatory landscape is really still changing. Many of the rules and regulations surrounding supporting organizations arose from the Pension Protection Act of 2006, so not that long ago, 10 years. And really for those Type 3 supporting organizations, the final regulations were issued just a few years ago. So really, things are kind of still shaking out in regards to these supporting organizations complying with the laws and regulations. All right. I think we're going to skip the question portion till the end, but now what I wanted to do is turn it over to Pam Alexanderson, who's going to chat on donor-advised funds versus private foundations.
Okay, thank you, Mike. We hopefully will have a few minutes at the end of the session for questions, but if we aren't able to do that, we do have the questions logged, and we absolutely will get back to those of you that have asked them. So appreciate your patience with that. So as Mike said, I'm going to start talking about private foundations, and then we'll move into donor-advised funds after that. And private foundations are 501c3 organizations, so they are exempt from income tax under 501c3 of the code, exactly as public charities are. Now, I know a bunch of you probably know that private foundations are subject to tax, but unless they have unrelated business income, they're not subject to unrelated business income tax the same way that public charities are not subject to that. They are separate legal entities, just as public charities, usually organized as corporations, so they will have articles of incorporations and bylaws, sometimes organized in the form of a trust. They are typically formed by a person, so everybody knows of the Bill and Melinda Gates Foundation, you know of the Kellogg Foundation, the Ford Foundation, so they typically are formed by a person or a family, and obviously the family name is in the name of the private foundation. And also very similarly to public charities, they have to be organized for charitable purposes. And underneath the charitable purpose will follow literary, educational, all of those things that are present in 501c3 of the IRS code in the same way they are for public charities. Private foundations most often are grant-making organizations, and they typically make grants to other 501c3 public charities, but can also make grants to a large variety of people and companies. The advantages of a private foundation is donor control. Typically, the donations to a private foundation come from the family, and obviously they would have control over what they do with those funds. And then donor recognition, just really by virtue of the name and that their family name is part of the name of the foundation. So some tax benefits for private foundations, and these are really, the first section here is really geared towards the donor, but they do get an income tax deduction for a donation to a private foundation. Unlike a public charity, you can get an income tax deduction, charitable deduction of up to 30% of your AGI, as opposed to public charities, which are considered to be 50% of AGI deduction. So if you hear of a 50% charity or a 30% charity, 30% charity is usually referring to a private foundation. You also get a deduction for appreciated publicly traded stock. And if the stock is held for more than 1 year, the donor can generally enjoy an income tax charitable deduction for the asset's full market value and avoid tax on the capital gain. The deduction limit is going to be 20% of AGI. Any donations beyond that limit can be carried forward for 5 years. You can also donate other appreciated assets, and in that case you would get a donation deduction of cost basis up to 20% of AGI. If you have publicly traded stock that you hold for less than 1 year, generally the fair market value of the contributed securities is deductible, but the deduction is reduced by the amount of gain that would be treated as short-term capital gain or ordinary income if the property had been sold. So not as generous on short-term stock. There is an unlimited estate tax deduction for a bequest to a private foundation. And as I mentioned before, the foundation itself is exempt from income tax, but they will be subject to excise tax on net investment gains. And we'll go over a little bit later with respect to 2% or 1% tax. Okay, that brings us to our first polling question. So please remember that you have to answer 3 out of the 4 polling questions to get CPE. So this one is, what type of private foundation may afford its donors an income tax deduction of up to 50% of AGI? Exempt operating foundation, private foundation, or private operating foundation? And I'll give you a few seconds to select your answer. Okay. A few more seconds, 10 seconds, and I'll close the poll. Okay, I'm closing the poll. So we're pretty well evenly split here, and sort of like Mike, I guess maybe a little bit of a trick question, but the answer is a private operating foundation. So a private operating foundation a donor can enjoy a deduction of up to 50% of AGI. An exempt operating foundation is a separate type of private foundation, but not usually seen very often. Some may wonder why somebody wants to be an exempt operating foundation, because they usually have to qualify anyway under a lot of the public charity rules. And then private foundations, just a general grant-making private foundation, can afford its donors an income tax deduction of up to 30%. Okay, we'll move on. So why would somebody want to form a private foundation? As we talked before, there's an awful lot of control that donors, again, which tend to be the family, can enjoy with a private foundation. They will obviously play an active role in the administration. For sure, when an organization is first set up, the administration, people holding places within the organization tend to be the family itself. They can also control whom, when, and for what purposes grants are made. So again, these are the people that donate the money. They're typically managing the organization, and they get a say on where the money goes. And then they also get to control the foundation's investments, which may be very important to them, since most organizations that's a lot of what they do is managing their investments. Donor recognition. The grant is actually shown as received from the foundation entity itself when a private foundation makes a grant to another organization rather than a sponsoring organization. So that does, again, give the family name recognition. And private foundations are allowed to make grants to individuals in certain situations. Some of the disadvantages is that they are required to make charitable grants of at least 5% of their net asset value, regardless of whether or not there's any income. So you have to distribute 5% of your net investment assets with an allowance that you're allowed to hold back for charitable purposes. But this rule was created to prevent the foundation from receiving assets and never actually distributing them. So general gist here is that a private foundation, as you go through time and you distribute 5%, 5%, 5% every year, probably the organization itself has a finite timeline. There are certainly a lot of costs associated with a private foundation to establish and terminate, so you have to be aware of that. You must establish your own administration and operations, so you still have to have the same governance that you would need to have with a public charity, and certainly that can incur a lot of legal costs. And then there's a number of rules that have to be followed. Jeopardizing investment rules. So jeopardizing investments are one that show lack of reasonable business care and prudence in providing the long and short-term needs of the foundation to carry out its exempt function. So you have to be very careful in what investments a private foundation intends to put its money towards. With respect to excess business holding rules, the amount of stock or other interest in a business enterprise, if it exceeds permitted thresholds, then you have violated that rule. A private foundation is generally permitted to hold up to 20% of the voting stock of a corporation, reduced by the percentage of stock actually or constructively owned by disqualified persons. And then taxable expenditure rules. We have an example here of no lobbying. If there are certain expenses that a private foundation makes, then you're going to be subject to tax on those particular expenditures. Some other disadvantages is that you must manage your own investments as opposed to a donor-advised fund, which we'll get to here in just a little bit. There is a separate filing requirement. Private foundations must file Form 990-PF every year. The grant information is going to be readily available. So all of this information is available on the Form 990-PF. It is a public document. It is available on GuideStar, and obviously lots of people can see that. So that really does make anonymity impossible for the most part with respect to a private foundation. Okay. Some other disadvantages are the excise taxes that a private foundation is subject to. So they are subject to an excise tax based on investment income. It is 2% or 1% of the net investment of 2% or 1% tax on the net investment income. And in order to not be subject to a tax penalty, you are required to make quarterly estimated payments. The 2% or 1% tax is just a calculation, and it is required to be reported on the Form 990-PF, and it's a calculation based on the distributions that the organization made in the current year based on the distributions that they had made for a historical base period, which is typically 5 years. So it's a calculation that's done on the 990-PF, and it will go back and forth each year depending on those distributions. Then there's also taxes on self-dealing. This tends to be a pretty hot topic for IRS, and there's a lot of rules with respect to self-dealing. So some of them we have listed here with respect to no sale or leasing of property with disqualified persons. Lending money or extending credit would get you a tax in self-dealing, furnishing goods, services, or facilities, payment of compensation. And the important part to note on the payment of compensation is that private foundations can provide adequate compensation to people that serve the organization, but it needs to be reasonable and not excessive. If it's excessive compensation, then that would probably constitute self-dealing, and there would be tax on that. And then transfer or use of income or assets by a private foundation for a disqualified person. Once somebody makes a donation to a private foundation, it is a completed gift, and those donations are property of the private foundation. They are no longer property of the donor who made the gift. Although the donor may have input on what to do with that money, they cannot personally benefit from assets of the private foundation. Okay, we're going to go on to donor-advised funds. Donor-advised fund is a separate fund. Usually, and almost always, they will have the name of the person as the name of the fund, and they are typically set up at community foundations. So I'm sure a lot of you in the audience that work at the community foundations have an arm of your organization that manages donor-advised funds. The community foundations are typically the sponsoring organizations. However, the donor or the donor's family can serve as advisors to those community foundations on where those charitable grants from the donor advised fund will actually go. Doesn't mean that the community foundation has to abide by those recommendations all the time, but they do have input into that. Donor advised funds are really easy to set up. There is no cost to set one up. You can go to your local community foundation, and again, they have people that work there that would be very happy to set one up. So it's very easy. You don't have to go through the Form 1023 application process as you do with a private foundation. There's usually a simple agreement that's signed with the sponsoring organization. There might be some fees associated with managing the investments and administering the fund, but they tend to be fairly minimal, and there is definitely no separate tax return required for a donor-advised fund. And then investment advice and that sort of thing is usually managed by the sponsoring charity, and then again with advice perhaps from the donor. Advantages to the donor is that typically these foundations or the Fidelity Charitable Investment Fund, large banking institutions that might manage donor-advised funds, they have an awful lot of knowledge. They've already done the research with respect to the grantees and can really advise the donor about the health of those grantees, the type of work that they do, so that the donor feels like their money is really being effectively managed and effectively going to the organization that they are most passionate about. Members of the family can also be fund advisors, and the nice thing about this, unlike a private foundation, is that grants to a donor-advised fund can be anonymous because there is no separate tax filing or public document that's out there available to everyone to see. Some disadvantages of a donor-advised fund is you cannot make grants to individuals. So it certainly is not like a GoFundMe page at all. That is prohibited. They are subject to expenditure responsibility for non-501c3 organization grants, and that just means you have to make sure that the money that you give those organizations is going for the purposes that you intended it to go. There are some limitations on business holdings, and that is that the holdings of a donor-advised fund in a business enterprise, together with the holdings of persons who are disqualified persons with respect to that fund, may not exceed certain limits. There are prohibitions on taxable distributions and prohibited benefits, similar to a private foundation in that respect. You cannot reimburse expenses of fundraising activities, and that sort of speaks to the last bullet, which is you cannot make a donor-advised fund grant to pay for tickets to galas for donors or tuition for family members of donors. So you have to be, again, when you make a donation to a donor-advised fund, it is a completed charitable gift, and the donor-advised fund is now the owner of that money, and that money cannot go to benefit a disqualified person or family member in any way. Some tax advantages is you get up to 50% deduction. It's sort of like a 50% charitable organization in that respect. Appreciated assets enjoy fair market value up to 30%, and you also get the carry forward. Okay, last polling question. How much of a tax deduction may donors receive when contributing to a donor-advised fund? And I know we're running out of time, so I'm going to give this just a few seconds. I'm going to close the poll. And most of you are right. Donor advised fund donors can get up to a 50% deduction with that. Okay, I think with that, we don't have a lot of time for questions. I think we're actually out of time. So we do have the questions logged, and we definitely will get back to you. I apologize, we ran just a little bit long. And so Pam, I'll turn it back to you.
Yes, thank you, Pam and Mike, for a great presentation today. Lots of great content, and we'll be in touch again shortly to those who have submitted questions through the Q&A box. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate will be available to download now in the CPE Progress window to the right side of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your certificate will be emailed within 2 weeks should you have any difficulty downloading it now. And then finally, here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.